some of you take material in with you. You can take the publication 2017 or 2018 publication that they give you, plus some notes they give you. But when you do the EA, it's all knowledge based, and so you've got to have it in your head. So
yeah.
Yeah, my microphone, right? Yeah. Okay.
Hey Ryan, can you hear us? Okay. Yeah. Could you pause the recording for a couple minutes? We don't need to record. So
all right, we're good to go.
thank you. So everyone, I just want to stress that we need to make sure, as of this point, you should be caught up with Chapter 9 reading, all the way from Chapter 1 through Chapter 9 in your reading. And I also want to share that if you're behind on any of this, it's okay. This is somewhat a self-paced course, but we want to keep you moving forward, and you want to make sure to not only watch the videos, but read the material in preparation for the video, and vice versa. You want to get through everything. So we're just sharing with you to keep you coordinated. Up till now, you should have gotten through Chapter 9 reading and watched the videos up through 6 videos up to this point, or participated in the live session for those that are live with us. So the other thing we're stressing, at the end of each chapter, and I've got a physical book here in front of me, but at the end of each chapter in your reading, there is a little quiz that you should take. And each quiz is like 10, 20 questions long, something like that. The answers are in the back. I want you to make sure to do those quiz questions. They will help you learn. But those are not enough questions for you to pass this exam. You really learn to pass an exam by reading material, listening to and interacting with a presentation, and then doing lots and lots of quiz questions. That's how you learn, so that when you miss a question, the material will tell you, why you missed it and what the correct answer is and why it's the correct answer. We really, really are asking you to invest in your own education here a little bit. For as little as $25 a month, you can buy into the Passkey online system, which will give you unlimited question bank. So for each chapter, at the end of for each individual chapter, you can pull up a set of questions and go through them. And I would encourage you to go through all those questions until you start seeing about an 80% passage rate. Then go to the next chapter and get yourself caught up all the way through Chapter 9. Okay? Because here's the goal. By the time you get through the end of all the Part 1 material, you should have gone through the reading for each chapter, the presentation for each chapter, like will happen today, and you should have gone through the quiz questions. Now, that's a lot to go through, and we are very aware of that. That's a lot of information to go through. But by the time you get there and those quiz questions, you're up around 80%. You're setting yourself up to be able to take a few of the, how many tests do we have, Ryan? I think we have like 6, something like that. Ryan may have had to step away. He's doing double duty today. But anyway, we have some actual practice exams is what I'm saying. We have some available. What we want you to do, though, and I believe that Passkey will have some practice exams too. The idea is if you can get each individual section so you're getting around 80%, then you go and do finally some practice exams and make sure you get up around 80%. Once you're there, you've set yourself up for success. Okay, so please, guys, go purchase that. Go purchase into that. It's only $25 a month, and once you've purchased it, you're going to be able to have access to all these quiz questions, and that's what you need for success.
Somebody said the other day that it was $40 a month.
Well,
updated
cheap
version.
Look, I'm trying to remember who wrote that or who told me that. Is it someone on the line here with us today? I can't remember. Do you remember, Garrett? Who told you?
I was thinking it was Linda Thompson, but I'm not sure. So.
Oh, wait a minute. I think you're right. I think it was Linda. Look, I can only tell you what I've heard. I haven't confirmed this. Somebody said they bought into it and then found out that they're actually changing the website. So that it's going to go to a new website, but if I understood right, there's still the $25 version is still available. $40 gave her even more access to other stuff. $40 a month. Keep in mind though, guys, I think $40 is really inexpensive. A month, you start it and then you just keep it going till you feel like you don't need it anymore. So we've set this course up to take about 4 months to get through. Okay. And that's moving really fast, to tell you the truth. But if you can get through that in 4 months, it's only going to cost you, even if you use the more expensive one, it's only going to cost you $160. If you use the cheaper one, it's only going to cost you about $100. So my point is please, guys, decide what your investment is. Make some kind of investment. Make at least the lowest investment so you have access to those quiz questions and the data and the quiz, the question bank. That's what you need. Okay. All right. Any questions about that?
But you would recommend the $40?
Well,
So that,
yeah, I think I would, because I think there's other stuff you're going to have access to, including I think they're going to give you access to an updated version, although we have the updated version of the book. So, you might not get anything more out of it. I'm not exactly sure the difference between the two. I know I was told that there's a version of the book available online if you're on the $40 version, but we've given you a copy of that too. So I'm not sure if there's a higher benefit. In fact, whenever we manage to get Linda on the group call again, we can ask her about it. Okay. What I do recommend is at least go and at least buy into the cheaper version where you got access to question bank. That's what you absolutely need, is the question bank. We don't have enough questions to give you. You need that to succeed. And it's a small investment. I always, by the way, the difference of $15 a month, $40 a month, for most people, they can afford it. I just am at, me personally, if it was me, yeah, no, I would do the 40 a month and just have access to pretty much everything. And knowing that after I get passing parts 1, 2, and 3, I can cancel it. So it's only for the time that you need it.
So July, if I will get it, July to
That's fine.
September?
Well, you just buy it for 1 month and then it just renews every month till you
Renew
cancel it. It's just automatic.
Okay.
Amanda, okay. Amanda says, okay, you talked me into it. Well, I am glad I did. I really am. I think you're going to need this to succeed. I think you need that question back. Okay, enough of this, guys. I've harped on this long enough. So, did everyone do their homework?
Yes.
Oh no.
Sheila did. Noemi, did I hear a oh no?
Yeah, I forgot. I have work, sorry.
Garrett, did you do it? Excellent. Okay, and Amanda? Some of it? Okay. All right, so this is what we're going to do. I want us to take a look. I want us to back up for a moment and take a look at, I'm gonna hold on a second, guys. I forgot I got to share my screen before I start popping stuff up there for you. Give me just a moment. Okay. Give me just a second here. I'm setting up my stuff so it's easier for me to keep track of everything. Okay, good enough. So, seriously. Excuse me a second, guys. Having a few technical difficulties on my end. There we go. So we had this practice. There we go. Remember self-employment, we asked you to do this, to jot down this information and do the Schedule C that goes with it. So I have something for you guys that I want you to use. I have the answers. So did everyone print out a copy of the Schedule C?
Yes.
Okay. Does everyone have a copy of the Schedule C that's live here right now that they can look at? Because I want you to fill this out if you can as we go through, if you have not done it already.
Yes.
Okay. All right. So everyone else is ready then. Okay. So first of all, on the Schedule C, this is a little hard because we don't see everything, but let me bring up something else that might be of value here. I'm going to have to stop this presentation to get at what I want. I'm going to pull something up that'll help us here. So here's the Schedule C. I got to move it over here where you guys can see it. Guys, I've got, like I've told you before, several different monitors, and so here I am moving stuff all over the place just so you can see things. Okay, so there's the Schedule C. Now you'll notice on a Schedule C that you're supposed to put in the name of the proprietor and business name and so on, what type of accounting method they're using. You answer a few questions. I kind of skipped over this even when I gave you the problem, which you can see right there. I kind of skipped over that, and the reason I did is that's simple. It's simple to do that upper part. What I really wanted to focus on this was this here. Okay, so first of all, I just wanted to kind of show it to you. So now, looking at this here, come on. Looking at this here, how much is the business income?
50,120.
Okay, that's correct. What line does that go on the Schedule C?
Part 1, line 1.
Okay, does everyone agree with that so far? I want anyone to speak up if you think anything's wrong as we go through this. So let's go look at line 2, returns and allowances. Did we say he had to return any money in this example?
No.
No. So you just leave that blank. Line 3, subtract line 2 from line 1. Well, we don't have any. Cost of goods sold. Did we say anything about him having cost of goods sold or anything like that?
Nope.
Okay. So gross profit, subtract line 4 from line 3. Well, there is no cost of goods sold, so we're not going to worry about that. Other income, line 6. Other income would include things like, okay, let's say you're running a tax preparation business, but you also happen to have a separate savings account for that business. Well, you might earn a little interest. Is earning interest the main point of your business?
No.
No, it's not. So that's the kind of stuff that goes here. Maybe you actually, perhaps you're renting an office space that has actually 2 offices in it, so you sublease it to someone else. So you're getting a little rental income from this. Is renting your main business?
No.
No. So that's where you'd put things like the profit, this other income. Okay. And then you add it all together on line 7. So how much should be on Helen's line 7?
50,120.
That's right. That's right. Okay. So how much is her advertising expense?
400.
And what line does that go on?
Line 8.
Yes, that's correct. Line 8. Okay. What about her business insurance expense? What line does that go on?
Line 15.
Line 15.
Line 15. What line does bookkeeping services go on?
17.
17.
That's right. And it goes on line 17. Why?
It's just
Professional services.
That's exactly right. It's a professional service. Okay. Supplies. How much supplies does she have and what line does it go on?
22.
Line 22. That's correct. How much is she going to put on line 22?
75.
7,500.
Exactly. Okay. So now how do you see here that there's business miles?
Yep.
See
Yes.
that? How is she going to account for business miles in her tax return on her Schedule C? What line would she
Mileage rate.
put? Right. Go ahead, Garrett.
I had to look it up on the instructions, but I had to figure out exactly how to do it for the Schedule C.
Uh-huh.
Use the standard mileage rate, multiply it times those mileage, and that's the number I come up with 37.49
Okay.
because it's 54.5 cents for 2018.
Yep. No, you're exactly correct. Did everyone else get the same answer that's been able to finish this?
Yes,
Got
37.49.
the same thing? And how about you, Amanda? I don't know how far you got, so could you tell me if you were able to get that? I'm sorry, Amanda. I was just waiting for a response there. There we go. Thank you. Perfect. So that's correct. $3,749. So what line does that go on?
9.
Line 9. Okay. So line 28 says add together all the expenses. So what's the total for line 28?
12,354.
Perfect. Line 29 just says take your income minus your expenses. So line 7 minus line 28 for line 29 gives us
7,406.
line 7 minus line 28 gives you what? I think you better do that math again.
Okay.
37,766.
Okay, let's
Yes.
make that's the answer I got too. So let's let everybody make sure we're getting the same answer. I think that was just a keyed something in wrong.
Well, I know why mine's different, so okay.
Okay, you found whatever the mistake was?
Utilities on line 25, the one you put up, you didn't include utilities, so I included the 360 as an expense. I included 10% of the
Oh,
from the
yes.
year because the office was 10% of the home office.
So what he's talking about right here is this rent for home and utilities for home. But can you deduct 100% of your home expenses?
No, you have to do the
No.
form 8829.
That's right, and we haven't, and we're gonna work with that, but we have not done that yet, have we? You're
No.
right. Okay, good
I
job.
used the simple method or whatever. I used that worksheet for the simple method. So to do the home
Okay,
separately down on line 30, it only came up to $500.
okay.
I thought that was just for the home itself, so I included the utilities separately.
I got you.
That
No,
was-
I get you. I get what you did, but that's okay. That's why we're doing this, is
Yeah.
to learn how to do it.
Perfect.
No, this is perfect. So this is good. So on line 29, $37,766. Now we're getting into the home stuff. So first of all, what's the first thing that we have to figure out to do business use of a home?
The percentage of the business use of the home. The home's
That's
1,000
exactly
square
right.
feet, and
And how do we do that?
divide the 100 by 1,000.
Square footage.
That's
of
right. We do it
entire
through
home.
square footage, and the actual calculation is just what Garrett said. 100 divided by 1,000 gives us what percentage?
10%.
10%. So it's going to be 10% of whatever expenses of the home that we're allowed to take. So what's the total annual costs that we're allowed to take for Helen?
It's 12,000 or 6,000, excuse me, for rent, because it's 500 per month plus the utilities of 3,600. So that's 9,600, right?
Yeah, 9,600.
9,600. Now, first of all, before we go any farther, does everyone see how he got to that? He took the $500 on the rent. He took the $500 a month times 12 months, got you $6,000. Then these were utilities for the whole year. So 6,000 plus 3,600 gives you 9,600, 9,600. Everyone see that?
Yes.
Okay. And then what percentage of that do we get to take?
10%.
10%.
10%. What's 10% of $9,600?
960.
960. So what number should be on line 30?
960.
That's exactly right. Yep. Okay. So line 29 minus line 30 gives us,
806.
that's exactly right, 36,806. That's perfect. All right. So setting that aside for a second, I'm going to bring this back up so everyone can see my completed practice here. See that? Those are the numbers that we just came up with. So there's his net profit and loss for the year. I'm trying to see if you guys can see me moving my mouse. I believe you can.
Yes.
Yeah, okay. There's the net profit and loss for the year. There's down below how we calculated it. Would it help you guys to have a copy of this, or do you guys feel like you got that?
Got it.
Okay. I am going to push it out, but that's only for the convenience of those that would like a copy of it. So I'm just going to push it out to you. So, answer. So there we go. Pushing that out to you guys. Those of you that want it can save it.
James,
Yes.
yeah, I'm trying to get the presentation materials, but it's not yet on the website. Can you push also the presentation materials?
Which one? Which
That
one are
one,
you?
the last meeting.
Okay, the last meeting. Yes, I'll do that right now.
Yeah, because I like to review and then
Sure.
I cannot.
There it is. There. No, I understand. Yeah, I know they're not on there yet. I'm sorry, guys. We've been short-handed, and so Ryan's been wearing 2 hats up north and not had time to do some of what we'd hoped to get done. But he's working on it. So, all right. So did you get that one?
Yes, thank you.
And that's the one that we actually went through yesterday. Okay. And okay. So self-employment. So it's not really that hard to do that Schedule C, is it?
No.
So what do you do with that number that's on line 31 of the Schedule C? That carries forward into your Form 1040, doesn't it?
Right.
As income.
Line 3.
Yeah.
Line 12.
Yes, yeah, but it's of the Schedule 1. I know it's confusing. Don't worry so much about exactly which lines they go to. Just remember it's getting into this 1040. It goes from the Schedule C to the 1040. I'm less worried about that you memorize the line numbers. Okay? And that's now taxable income. And remember, if we back up now a whole week, when we stopped last, before we got into this, when we last stopped, we were talking about what's taxable and what's not taxable. So that's all we're talking about here is what's taxable. Well, net profit and loss from a business is taxable. This is how you do it. And I'm just holding up the Schedule C for those that are looking at it. That's how you do it. You do a Schedule C, calculate it, and then you carry it into the other form, the Form 1040. Okay. Now we also did a quick rental. Who got the rental done? Can everybody just either say yes or type yes if you can't talk right now?
No, I didn't know I needed to.
Yeah, we gave you the rental information.
Oh,
It's okay. At the end, it's all right.
I got it done this morning before class. It wasn't that complicated. So.
No, guys, the whole thing I tried to really point out to everyone is a rental is so similar to a self-employment. It's not exactly the same, but it's still the same concept. Income minus expenses gives you a net profit or loss. Okay. So it's okay. I just want to know how many people were able to get it done. So Amanda, you didn't get it done. That's okay. Noemi, were you able to get this one done or not?
No, sorry.
It's okay. So let's go ahead and do it together. Okay. So does everyone have a copy of the Schedule E to work with?
Yes.
Okay. So Noemi does. Amanda, do you have one to work with?
I don't, but I can pull it up.
Okay, would you? And Garrett has his.
Yep.
Okay, yes, please go ahead and pull it up, Amanda. Just pull one off the internet. I've got one, but truthfully, the copy I've got is faded for some reason, so I hesitate to use it. Okay, so Sheila and Amanda, would you let me know when you both have it pulled up? And Noemi, you said you do have a copy already available, right?
Yes, because you asked us to print last
Yeah,
session.
yeah, yeah, that's right. And I appreciate it. Because what we're going to do is we're just going to work on this one together, okay?
Okay.
Okay. So I'm just waiting for everyone to say they've got a copy in front of them so we can kind of work on it together. Okay. And let's see. Noemi has it. Garrett has it. So Sheila.
Got it.
Got it. Perfect. Okay. So let's start at the top. You see under names, names shown on return, what name do we put there?
Helen.
Jack Adams.
Jack.
Oh yeah, look on the screen. I've thrown up on the screen the actual practice for rentals. Okay. So Jack Adams. Let's look at this together real fast. Jack on the screen. Jack Adams owns a rental house which he rented to his family all year. And here's his information about his address. And then we'll go through the rest of it together as we work through the sheet. So what name should go?
You had Anchorage, Alaska on there.
I know. I changed that this morning. It's okay. It's not critical. It's because I was teaching Alaska last fall. I was teaching people in Alaska. So I did change it. I just made it local. So Jack Adams should be in the name. What social security or his social security number should be off to the right of the name. Now you can see I just when you get my copy of it, you'll see that I just made up a social security number, but the social security number would be there. Okay, so look at under part 1 there, it asked a question. So Garrett, what's that question? The A question. Read that to us, would you?
Part 1A, did you make any payments in 2018 that would require you to file forms 1099?
Now, did I give you any information that told you anything like that?
You did not.
No. So we answer no to that. The second question there, the B question, says if yes, did you or will you file the required forms 1099? Well, we don't have to answer that because we answered no above. Okay, so now under part 1, we're going down to line 1A, big A. Now, why do you think there's a capital A, capital B, and capital C? Why do you think there's 3 of them listed there?
Because you have more than one property.
That's right. In case you've got maybe 2 rental properties or 3 rental properties, you can list them all there. If you only have 1, then you just use line A. So on line A, what address should be there?
555 McKinley Street. Yeah.
Yeah, that's right. Eugene, Oregon, 97405. Or for Garrett, who actually got it done, it was Anchorage, Alaska before.
That's the only reason I knew that, because I put that in the address line. So.
No, you're right. You're right. But don't worry about it. That's fine. You're getting the point that you put the address there. Okay, now look under line 1B. What is the little word next, or what does it say next to line 1B, Noemi?
Type of property.
Right. So what type of property is property A?
Rental house.
Okay, but
down
you got it.
But says type of property,
hold on a second.
Listing of them.
Right. So notice 1B says type of property from list below. So which type of property is property A? No
Real estate.
It is, but you got to choose from the list below. Do you see that list?
Okay.
You see that?
Yeah.
Okay, so go ahead and read through that just to yourself and tell me which one you think you would put there.
Mm, single family residence, multi-family residence, vacation, short-term rental, commercial land, royalty, self-rental. It is a vacation?
No, probably not. If you were a real estate agent, what would you normally put on there?
Ah,
What
okay.
would think
If
about
you,
it in those terms.
yeah,
Commercial?
no, that's okay. That's okay. Let me help you. Somebody help her out. Okay.
Says on the screen that we're looking at, Jack Adams owns a rental house which he rented to a family all year.
So if Jack is renting a rental house to a family, which type of property do you think it would be? Single family residence or multifamily residence?
Single.
Yeah, there you go. So what number should you put on? 1? There you go. Just to clarify, because this brings up exactly what could be confusing, single family residence means a house that can only handle one family.
Okay.
Multifamily residence is usually something like a duplex, although truthfully you can treat a duplex as 2 separate rentals as well.
Guys, legally in real estate terms, it's the number of entrances to the house. If it has, count the number of front doors, not, back doors or anything like that. Count the number of front doors that a house has.
Yeah.
And if it actually has 2 front doors, in other words, 2 separate residences in it, it's normally a multifamily.
Mm-hmm.
If it only has 1, then it's normally considered a single family.
Good. Yeah. Now, what is a vacation rental? A vacation rental is one where, like, maybe somebody could own a house that they rent out. Maybe it's near Mount Hood and they rent it to several different people throughout the year. That would be a vacation rental. It's only rented for like maybe a week at a time. In fact, Ryan and his family go to a vacation rental, don't you guys? I think you do.
Yeah, we do.
Yeah. So you actually go in and they're renting something that belongs to somebody else, but they're renting it for like a week at a time, and that's a vacation rental. Commercial. What's an example of commercial rental?
Like an office building or an
Office building, office space. Yep, exactly. The rest of it, don't worry so much about, okay? Just those are the big ones. But realistically, the ones you in real life are going to run into doing personal income taxes returns are going to be single family residence, multifamily residence.
What is self-rental?
What is
Sorry.
which one?
Self-rental. She's
A
asking about
self-rental means you can actually, if you own the property and you rent it from yourself, let's say you have a business that it's licensed under like an LLC or something of that nature, and you actually rent it personally from your business. So if it's a self-rental, you're literally renting from yourself.
Yeah. So look, if that's
But that's
if that
so
made,
rare, don't.
right.
Yeah.
If that listen, if that made sense to you or anyone else that listens to this, if that made sense, that's great because that is accurate. If it didn't make sense, please just forget it because you don't need it to pass the test.
Yeah.
Okay.
It's not something to worry about.
No, it's really not. That's why that's why I'm not really going beyond the top 4. Okay. So look in box 2 across from box 1. It says for each rental real estate property listed above, report the number of fair rental and personal days. So what are the fair number of what are the fair rental days, the number of fair rental days for property A? First of all, does everybody see where I'm talking about? If not, please let me know.
It's off to the right there.
I think I better pull this up because it's confusing the way they've set this up. Give me just a minute. I got to move it over to this screen where you guys can see it. Okay. I'm talking. Okay. Everyone can see this? Can you see here? Right there. There's box 2.
Yes.
So how many fair rental days did Jack have of renting it out?
All year,
All year. So how
365.
many days in a year?
365.
365.
That's right. How many personal days did he use it for personal use?
0.
0. That's right. Now, do you remember us talking last session about a qualified joint venture?
Yep.
Okay. What is a qualified joint venture? Can somebody define that again, just to refresh our memories?
Isn't that when like two people, like a married couple, both are have equal ownership stake in the property?
Yeah, it'd be like, let's say a married couple. Let's say Jack, let's pretend for a second Jack was married. Jack and his wife both own the property. They both can share equally in this. Okay? Rather than one getting all of the credit for Social Security and everything else, or getting credit for everything, they can, rather than treating it, doing that, they can treat it as a qualified joint venture. Because normally, let's say Garrett and I were to go into business together. We both buy into a rental house. Well, now we've got a partnership. We're going to have to do a partnership return and then pass all that information through to each of us individually so we can do our own individual tax returns. Does that make sense, what I just said about if Garrett and I were in business together? We'd own a partnership. We have to split everything equally, or not necessarily equally, but we have to split everything. In a qualified joint venture, if you have a husband and wife that own everything, or husbands or wives, if you have spouses that own everything together as two equally, they are still a partnership. They'd still have to do a separate partnership return, but the IRS allows an exception for married couples. They can choose to be treated as a qualified joint venture where everything gets thrown together and it's dealt with it's dealt with that way. So if you had a husband-wife situation or a married couple situation and they both owned it and they both wanted credit for what's here, they can choose qualified joint venture just by checking that box. That makes sense?
Yes.
Yeah, and that's all you really need to know. Don't worry about anything else about qualified joint venture. It's just between the married spouses where they both own it and they both want some benefit for owning it. And so you just got to mark that box. Okay? All right, I'm going to minimize that. I'm going to come back to here and back to there. Okay, so we're through that part now. Now we're going to go into income. Where do we report, which line do we report income on? Line for rent, line 3 or line 4?
3.
And in which column are we going to in this example, in which column are we going to report the line 3 rent income? A, because that's the only one we have above. That's the only rental that we're talking about. How much rent did he have for the year that he has to report? Rental income.
$12,000.
$12,000. So on line 3A, in other words, line 3, column A, there should be $12,000. Okay, so does he have any advertising expense? Line 5, expenses, because we're going to talk expenses now. No. Does he have any auto or travel expenses?
Yes.
Yes, he does. What does he have? Somebody tell me what he has and how we're going to figure out what to put on the Schedule E.
200 miles.
200 miles is what he has. Okay, so what do we do with that 200 miles? Because we can't put 200 miles on Schedule E. That doesn't mean anything for...
Multiplied by standard mileage.
That's right. What's the standard mileage rate?
0.545.
That's right. So what is the amount that Jack can deduct for use of his automobile for the rental house?
109. 100.
That's right. That's right. And how did you get that, Noemi? That's correct. How did you get that?
200 miles times 0.545.
Perfect. That's exactly right. So on line 6, you write 109. Okay. Does he have any cleaning or maintenance fees? Line 7.
No.
Any commissions on line 8?
No.
Any insurance on line 9?
Yes.
Okay. How much?
500.
500. Any legal or professional fees listed there?
No.
Real estate
Line.
taxes.
Yeah, but that's not a legal or a professional fee.
Oh, no, it's not. Yeah, sorry.
Yeah, you're correct. Are any management fees listed here?
No.
No.
Now, what are management fees?
If you have a manager that takes care of your property for you.
Yeah.
And sends you your rent every month.
That's right. That's correct. That's correct. And Amanda, I saw your answer, and that's correct. Yeah, it's a management company. Okay. How about line 12, mortgage interest paid?
Yes.
Okay, and how much goes on that line?
750.
Okay, 750. Is there any other interest here? Line 13.
No.
No.
Any repairs for line 14?
Yes.
And how much again, guys?
350.
350. Any supplies expenses here?
No.
Okay. On line 17, excuse me, I jumped over line 16. Taxes. How much taxes did he pay?
1,100.
That's right, 1,100. Are there any utilities he paid for this rental house?
No.
Depreciation. Now, normally you would calculate depreciation and put it here. I just gave you a flat amount of depreciation. So you'd put how much on line 18?
2,000.
Yeah, from this example. So no other expenses. So have we gotten through all of the expenses then?
Looks like it.
Yeah. So now what does line 20 tell us to do?
Total them up.
Total them up. How much total expenses do we have?
$4,809.
Okay. 4,809. Everyone agree with that?
Yes.
Okay, perfect. Now, what does line 21 tell us to do? It tells us to take your income minus expenses. So line 3 minus line 20 leaves you with what?
7,191.
That's correct. 7,191. Okay? And that's what you write on line 21. Now, on line 23, you'll notice that they want you to total up some things. Line 23A says total of all amounts reported on line 3 for all rental properties. What is line 3?
Rents received.
That's right. So what they're wanting you to do is go across line 3. In fact, I think it would be good for me to bring up the this again so you can see it. So notice line 3, rents received. You have property A, B, and C. It's asking you to add up all of the amounts from line 3 in all of these columns. So if we had more than one rental property, it's adding up all of the income from the rental properties, all of your different rental properties. Now in this case, it's 12,000 plus 0 plus 0. So it's 12,000 down here. Let's look at 23C. Total all the amounts reported on line 12 for all the properties. What is line 12?
Line 12 is mortgage interest paid.
Yeah, so it's asking you to add the mortgage interest from property A and property B and property C if you have other properties. In this case, how much would be carried down there? 750. Okay. Total of all amounts for line 18 on all properties. What's line 18?
2,000.
Yeah.
Well, you're correct. That's the amount, but what is
Depreciation.
it? Right, depreciation. That's what I was looking for. You're right. It is 2,000. But again, what it's trying to do here, what it's doing is it's getting you to add all of your income from all of your rentals, all of your income from all your royalties. That's what 23B is, but we don't have any royalties. All the mortgage interest that you paid for all of your real estate, and all of your depreciation for all of your real estate. And then line 20 is your total expenses for all of your properties. That's all this is doing. It's breaking it out. And then you'll notice all of the expenses should come together and get totaled here. And what are we talking about? If you had more than one property, you would be adding up all of lines 21. You'd have all of your expenses for all of your properties. Okay? That's all it's doing. It's breaking it out. And why? Well, it has to do with those limitations we talked about. Remember, you can only have a certain amount of a loss. You normally cannot take loss on a rental property because it's passive. Remember those general rules that we were talking about? Okay, I think I threw too much at you there. It's okay. Let me back up. It's okay. What I'm talking about is why are they doing this? Because they need to break it out so you can apply those limitations that we talked about. Remember these limits? If you have a loss, 2 limits apply. The at-risk limit says you can take a loss only up to the amount you're at risk of losing your investment. And passive activity limit, usually you cannot take a loss for passive activity such as rentals. Exception is if you actively participated, you can deduct losses up to $25,000. Remember that?
Yes.
That's why they're doing this, because you got to add all these things together, because guess what? If you have more than one rental and you have a loss from one rental but a gain from the other, you can use it to offset the loss as long as you have a gain somewhere else. So that's why they're comparing it. That's all that they're doing, is they're comparing it. They want you to add it together from all of the different rental activities you have, because that's how you determine, first of all, if you have a loss, and then how much is it at, then you can compare it, run the at-risk limit test and the passive activity limit test. That's exactly why. Okay? All right. Any questions about that? All right. I'm going to send this out to you just so you've got a copy of the answer if you want it. You don't have to use it. And it's on its way, and there it is. Okay. So before we move on, let me tell you where we're going next. We're going to go into a little bit more detail about rentals. There's some more detail that is actually important, and we really do need to discuss it. And we need to let you know what those additional details are. I gave you a very high-level overview. With that rental. I wanted to show you how simple it is and how close it is to just doing self-employment. But there are some special rules, and that's what we wanted to discuss now, okay? So first of all, let's talk about rental income. And by the way, I'm going to kind of breeze through this because all you got to do is know a few of the special rules, but the rest of it's the same. Rental income, what is important about rental income? Along with regular rent payments, rental income also includes things such as advance rent, security deposit. What's a security deposit? That's when somebody puts down, like they move in, they put down a security deposit that they can get back as long as there's no damage that needs to be fixed when they move out. Lease cancellation. What is a lease? Well, you may actually, it's basically a rent for a period of time. You agree to rent this for a period of time, so you enter into a lease. And if you cancel that lease early, you're going to pay a penalty. Expenses paid by the tenant. The tenant's the person renting it. So some expenses are paid by the tenant. Property or services that are received instead of actual rent money. Lease payments received from the tenant who has an option to buy. Those are all different types of rental income. We're going to talk about each of them real briefly. Advance rent is included in rental income in the year the taxpayer receives it, regardless of the period it covers. So what is advance rent? Well, I have a rental and I have somebody move in and I say I want first month's rent and last month's rent. So I'm actually getting 2 months rent before I let them move in. The last month's rent is advance rent. So an example, Carlos signed a 10-year lease to occupy Ari's rental property. In the lease's first year, Ari received $5,000 for the first year's rent and $5,000 for the last year's rent. Ari must include all $10,000 in rental income in the year he received it. So the first year's rent, which would be the regular rent we think of, but also last year's rent. Okay? So got to include all rent when you receive it, even if it's advance rent. Security deposit payments is what we're going to talk about next. These are payments that the taxpayer, the person who owns the property, plans to return to the tenant at the end of the lease if it's not is not included income when it's received. In other words, if you as a landlord get some security deposit, say $500 pet security deposit, you do not include that in your rent. Why do you think that is? Why would you not include that in your rent income?
You will return that to the...
Yeah, you're going to return that. Hopefully you'll be returning that to your tenant. When would you maybe not return that to the tenant?
If it's in the lease contract that it's not refundable.
Well, yeah, but you're right, Sheila. But that's a little deeper than I was thinking. What I really was trying to get at was your tenant moves out. Yeah, there we go. Amanda came up with they trashed the house.
Yeah.
And or the dog trashed the house if it was a pet deposit. The dog trashed the house, so you have to replace a rug for say $400. They gave you a $500 deposit, so you keep $400 of that. They give them the $100 left over. That's what a security deposit is for. It's for security, so there's some money there in case something happens to the house that's because of the fault of the tenant. Okay. And what Sheila was bringing up has to do with more lease. There are circumstances where you still might keep it, but I didn't want to get that into it because there's some special rules that can apply. And guess what? To pass this exam, you don't need to get into all those exceptions. So a security deposit that the taxpayer plans to return to their tenant at the end of the lease, you do not include that in income in the year that you receive it. However, when and if the taxpayer keeps a portion or all of the security deposit, that's when you include it in income. So a security deposit that is intended to be the last payment is considered advance rent. In other words, if it's really meant as last month's rent or last year's rent as opposed to security deposit, you include it. Let's look at an example. Leda rented a 2-bedroom apartment to Mark. Before Mark moved in, he gave Leda money to cover his first month's rent, first month's rent plus a security deposit of $500. Leda plans to return the security deposit to Mark if there are no damages to cover when he moves out. Therefore, none of the security deposit is included in Leda's rental income for the year that she received it. When Mark moves out, Leda returned $150 of the security deposit, but kept $350 to cover repairs or damages. Leda must include the $350 as if it was rental income in the year she keeps that money.
But then she deducts the $350 as damage repair.
Yeah, it's still a deductible expense to her, but she still has to include it in income. What we're focusing on is we're focusing only on rental income at the moment. When you're 100% right, she can do that. But what we're trying to say is there are certain circumstances where you treat something as rent in the year you get it, and certain ones that you don't treat it as rent income when you get it. Security deposits you do not treat as rental income until and if you ever keep part or all of it.
Aren't we supposed to go in an escrow account?
It doesn't really have to.
No.
If it's a private individual, there's no law that says that. You do have to keep it, though. You can't just go and spend it.
Yeah.
Only if you have 6 or more rentals.
Yeah.
Is what
But
the law is.
But the problem is if you start getting there, you're probably no longer just doing rental. You're probably running a business. And here's the thing. If you are in the business of renting, if your main income is from buying up rentals and renting them out, are you going to use a Schedule E for rental, or are you going to use a Schedule C for self-employment?
C.
T.
C. Yeah, C is in Charlie. Self-employment, because if you're doing that as a business, it's actually Schedule C. It's no longer Schedule E. Okay. Okay. So let's talk about canceled lease. If the tenant pays the taxpayer to cancel lease, the amount paid is considered rent. So let me give you an example a real life example that I know of. I do have a rental house, and when I move somebody in, I promise them actually a slightly lower rent if they will agree to sign a lease for 1 or 2 years. And they are allowed to, but if they cancel lease early, they have to pay me $500 for an early cancellation. Okay? So that's basically what they do. Okay? So if I got a lease and they cancel the lease and they pay me that penalty amount, when they pay me that penalty amount, that's the year that I have to include that in my income. So Andy and Sarah, here's an example they have. Andy and Sarah broke their lease agreement with Juanita by moving out of their apartment within 3 months before their lease was complete. The cancellation fee was $450. In the year that Juanita gets that $450, that's when she has to include it as if it was rental income. It's that simple. Expenses. Now, if the tenant pays for any of the taxpayers or owners' rental property expenses, that money is going to be considered rent. So the taxpayer can deduct the expenses if they are for an item that is a deductible rental expense. So here's an example. Anthony rents an apartment from Lisa. He spent $250 on drywall and supplies to repair the water damage to his apartment. In exchange, Lisa agreed to reduce Anthony's rent by that amount for that month by $250. Lisa must include that $250 in her rental income, even though she didn't physically get it. Why? Because he spent $250 for her and paid her that much less. In other words, she still got the equivalent of it. And this is where Sheila was spot on. Notice she can deduct the $250 as a rental expense. Does that make sense what we're doing here? I want to make sure that doesn't get confusing.
Yes.
Yeah, because all it is, guys, think of this as his income. This is not a whole lot different than if, in this example, if Lisa had just gone ahead and Anthony had paid the full amount of his rent, not decreased it, and she spent $250 on drywall and supplies to get it fixed. She'd just deduct that. The only difference here is he pocketed the money and took it out of the rent before he paid it. So he came out the same, she came out the same. Okay. Property or services. If the taxpayer receives property or services instead of actual money as rent, you take the fair market value. And the fair market value is what you include in the rent. Now, if services are provided if they agree ahead of time what the service is worth, that price is going to be recognized as the fair market value unless there's some evidence to the contrary. So, oftentimes in rental situations, somebody says, hey, you know what? I'll buy this stuff to fix this and I'll do the work if you'll just decrease my rent by X number of dollars. Well, as long as it's not unreasonable or some other evidence to the contrary, that X number of dollars is going to be considered the fair market value. And the fair market value of of property or services has to be included in income. Now, does that make sense why that would be? Fair market value for property and services. So that, you know, your renter agrees to fix up a room for you, repaint it, and do things for you. You take the fair market value of that. And you guys might have agreed on what the fair market value is. You take the fair market value of that because they're doing a service for you, and that's as if you're getting the value out of it. So that's income to you as rent, and you treat it as rent. Lisa and Anthony, here's an example. Lisa and Anthony also agreed that she would reduce his rent by an additional $300 for his labor to make the repair. Lisa must include that $300 as rental income. Well, that makes sense. He's
Yes.
doing work for her, and she's not actually paying for it, but she is taking less. She's giving him a break on the rental income. Well, that's income to her. But again, just like Sheila pointed out, she can deduct that as a rental expense. All right, lease with option to buy. What are these? A lease with option to buy is if the rental agreement gives the tenant the option to buy the rental property at some point down the road. This is not as complicated as it sounds. It's this simple. Until the tenant chooses to buy and actually does buy the property, all the money paid is rent. Once he buys the property, from that date on, everything is part of the cost of the sale. It's no longer rental income. That's all it is. So Arnold rented his former home to Calvin 2 years ago, giving him an option to purchase the property. In July of this year, Calvin bought the home. So it's in July, he bought the home and paid Arnold $53,000. Well, that was a good deal. That's a cheap house. Arnold must report Calvin's rent payments from January through June. Remember, he didn't buy it till July. Calvin's July payment and everything thereafter, if he's making payments to him, is not considered rental income. That's part of the sales price. Pretty simple, huh? How about payments that are not considered rent? When would you take money in that's not considered rent? Well, if the taxpayer rents out the property that they also use as their home for fewer than 15 days during the tax year, do not include the rent they receive in their income and do not deduct any actual rental expenses. So what we're saying is if you rent your personal home out for 14 days or less, exactly 2 weeks or less, 14 days or less, then you do not have to include that rental income in your, that rent that you received as income, but you also don't get to take any expenses against that. Let's look at an example. Martina lives in an area where the Super Bowl was held. She rented her property for 2 weeks while she was out of town. The rental income Martina received for this 14-day period is not included in her income, and she does not deduct her related expenses. That's all. Okay, which item is not considered rent? Go ahead and read that through and then tell me your answers.
Please read. I don't see the slide.
Oh, you said please read. I'm sorry, misunderstood you. Which item is not considered rent? A, advance rent. B, lease cancellation payment. C, returned security deposit. Or D, owner expenses paid by a tenant. Which one of those are not considered rent?
C.
Yeah, that's right. That is right, and everybody got that answer correct. Good job. Next one, Rico paid $1,200, so $1,200 during the tax year to rent an apartment from Selena. Of this payment, $900 was the first month's rent, and $300 was a security deposit. Selena will return the $300 to Rico when he moves out of the apartment if there are no damages. How much of this income should Selena report as rent? So, of that, just tell me how much should she report?
900.
And I'm waiting. Okay. Yes, 900. That's correct. Sorry if I jumped the gun on some of you. I couldn't tell who had answered and who hadn't already. All right. Oscar paid a repairman $100 to fix the dishwasher in the apartment that he rents from Mary. He deducted that payment from his rent of $1,000 and paid Mary only $900 for the month. How much rent did Mary receive for the month that she has to include on her income as her income?
1,000.
Everybody either type or say their answer to me before I put it up there. Okay. You guys are all right. All of you got the right answer. It's $1,000. That's exactly right. Helen rented a house from Frank. Okay. When she moved in, she agreed to paint the interior in exchange for not paying 1 month's rent of $500. So she agreed to paint it, and she's not going to pay rent for 1 month worth $500. She spent $280 for paint and supplies. How much rent did Frank receive for the month? And just type in your answer in dollar amounts. Or you can say it if you prefer, that's fine.
500.
Okay. Waiting for everyone else's answers. Come on, guys.
I put A, 0, in my opinion. He didn't receive anything. He can still claim it that he got it, but he didn't actually receive anything. So that's the way I read it.
Okay. So, who am I missing? Oh, Sheila, are you still with us?
I responded 500.
I'm sorry. I didn't hear you, and I don't see it on my chat, so that's all.
It's me.
Okay, that's fine. All right. So the answer is 500.
Okay.
Sheila, why is it 500?
Because he does have to claim it as rent because he made that agreement with her.
Yeah,
But it
because
is asking what he received, not what he claimed. So that's why.
how much
Because-
rent did Frank? Well,
He constructively received 500.
yeah, that may be a way to think of it, Garrett. Yeah,
Okay.
exactly right. It's a constructive receipt. Keep in mind what we're and I get your point. Literally, he didn't physically receive it, but what they're trying to test in is what is he got to be taxed on.
When the IRS asks questions like that, they word it specifically to trip you up. So
Well,
I was had that in mind.
I get it. But so he physically received nothing, but
Right.
taxable income is still $500 because
Yeah.
that's what it cost him to get cost him to get this done, but he also got a $500 benefit. So again, just like Sheila mentioned before, a lot of these situations, you have to include it in income, but you can offset it as an expense. So it really is going to zero out anyway. Bob and Joan live next to a golf course. When a major tournament was held at the course, they rented their spare bedroom for the week to one of the participants for $1,000. This is the only rent they received during the year. How much rent must they include in their income? Sheila and Garrett have their answers in. Oh, wait a minute. Sheila and Garrett. Amanda? And I'm just waiting for one more person.
Me?
Yeah, Noemi?
Yeah,
Just-
0.
Okay, the answer is 0. Why is the answer 0, Noemi?
It is only for a week.
That's right. Remember, there's that rule that says if it's your personal home and you rent it for 14 days or less, don't include it in your income at all. It's one of the rare times the IRS lets you get some income and not report it. It's one of the very rare times. So does that make sense to everyone? Why it is that way? Cool. All right. All right, so let's talk about rental expenses. First of all, rental cost and expenses for operating a rental are deductible against the income received. In other words, just like business, income minus expenses. And expenses include the cost for managing, conserving, or maintaining the property. I'm sorry, guys. I digressed for a second to take care of something. Ryan, do you happen to be live on the line right now? Okay. Don't worry about it. Sorry. Just a business thing where I was trying to take care of. An emergency came through. So it's the same things that we talked about before. So some of the rental real estate expenses are treated exactly the same as self-employment expenses. Auto, travel, and transportation expenses treated the same as self-employment. Insurance paid in advance, where you have to actually split some of it up sometimes if you pay it for more than a year. Legal and professional fees, tax prep fees, those are all the same as self-employment. And we proved that when we did the Schedule E and the Schedule C. You noticed how closely aligned they were. Taxpayers can deduct their ordinary and necessary expenses. I want to stop there for a second. Remember when we talked about self-employment, what expenses can you take? They're ordinary and necessary. That's important words to remember for the test. Self-employment and rentals, you can take expenses that are ordinary and necessary. Ordinary for what you're doing and necessary. That doesn't mean required, like the house is going to fall apart if you don't do it, but necessary meaning it's part of what you normally would do to take care of a rental or take care of your business. That ordinary and necessary applies to both. Taxpayers can deduct their ordinary and necessary expenses of traveling away from home if the primary purpose is to collect rent or manage somehow the property. Or if the expenses must be the expenses must be allocated between rental and non-rental activities. If you're traveling away from home for both personal and rental purposes, you got to divide it up in some reasonable way and only deduct the rental portion of the travel. You got to keep records of expenses. Isn't this a general rule you always use anytime you're claiming something on your return as an expense? You always keep records. You've got to, otherwise they can take it from you. Taxpayers cannot deduct the cost of traveling away from home if their primary purpose is to improve the property. So if a person is traveling an hour away to a rental just to pick up rent and maybe do a little bit of fixing a couple of repairs, maybe a broken pipe or something, he can include that trip. He cannot include the trip if the primary purpose is to go put on a new roof, because that's an improvement, isn't it? Mm-hmm. Yeah. Repairs to rental property are deductible if the repair keeps the property in good condition and a true repair does not add to the value of the life or prolong its life. Repairs are made to the extent as part of a remodeling project are considered improvements. Do you remember what it takes for an improvement? Remember back a few sessions when we talked about basis?
Yes.
What are the three things that go into an improvement? What are the three possible things that go into an improvement? An improvement is something that, what's the first one?
Extend the life of the asset.
Okay, that's one of them. Extends the life. What else? That's right. That's right. Amanda, I want to say something. Amanda clarified extends the life of 1 year or more. You're 100% right. What else, Sheila?
Increases the value.
Uh-huh. And what is the other one? Okay. An improvement is something that increases the value, extends the life, or converts to a different use. increases value, extends the life more than a year, or changes to a different use. So just to keep that in mind, that's the difference between that and a repair.
Okay.
So a repair, you can take 100% of the cost this year. If it's an improvement, you have to take it over several years, and we call that what? How do we take the cost of something over several years? An item that's going to last longer than a year. Depreciation, that's right. So if you do an improvement, like put a new roof on the house, you don't, and it cost you $7,000 to do it, you don't take all $7,000 in the first year. You depreciate it over several years. Remember that? Everyone, does that recall that? You recall that from our discussion on basis?
Yes.
Okay.
More or less.
All right. Who said more or less? I just want to
Sheila.
know. Sheila. Okay. Yeah.
Gets foggy.
Yeah. But keep in mind, this is the same stuff over and over again. All we're doing now is something you already know. We're just applying it to rentals. That's all we're doing right now. So remember, you can actually, in a business or a rental, you can actually deduct or expense the cost of something that's a repair. Repair just fixes it and puts it back into service, what you're repairing. An improvement is something that increases a life, extends a life, increases the value, or converts to a different use. If it meets one of those, it's an improvement, and that you're going to actually depreciate over several years. That's all. So you expense part of it each year. And that's all depreciation is you're expensing a little bit of it each year. Okay. Interest on loans that are secured by rental property can be deductible as long as those loan proceeds were used to actually acquire, improve, repair, or maintain the rental property. And you recover the cost of your rental property through depreciation. And what I mean by rental property right now is the cost of the house. Okay. That's all we really got to do. So when does depreciation begin? Depreciation begins when, Garrett?
When the property is placed in service.
Okay, that's correct. And when does it, and it continues during the entire time that you own the rental property and that it's actually being used for rental purposes. When does it end?
When you sell the property.
That's right, or it stops. That's correct. Most of the time that's the answer. It can also be when you stop using it for rental purposes. Yep, that's correct.
So if you have a property that you and your family buy, and then 5 years down the road you buy a new house and you rent that property out, and then 7 years later you move back into the property for 2 years, and then you move out and convert it back to a rental again. You can restart the depreciation again at that later point, but you don't get to claim it the 2 years you went back into it, correct?
Yes. Short answer, yes. Yeah. But let me tell you, be very careful if that ever happens, because you can really mess up depreciation in that situation.
Yeah, I know.
Easy to do. Okay. So that's all it is, depreciation. So let's look at this. Deshaun bought a rental house in May. He spent 3 months making renovations, and on September 4th, it was finally suitable for tenants. Deshaun began advertising for a tenant on September 4th. His first tenant, Kennedy, moved in October 1. Even though the house was not rented until October 1, he can start depreciating it on September 4th. Why?
It is available.
That's right. It's available. In other words, that's the first date he placed it into service.
Yes.
Yeah. Kennedy moved out of Deshawn's rental house at the end of July of the following year. So Deshawn spent the month of August making repairs and placed an ad for the new tenant in September. He finally found a tenant on December 1st. Deshawn must continue to depreciate the house during the time it is not available for rent while he was making repairs and during the months before he found a new tenant. And okay, so let's just stop there. Why do you think that would be?
It was still technically a rental property.
That's right. It was still that you're 100% right. The reason is because it's still in service. He just could not actually rent it for a few months while he fixed it up from the damage that was done. That's exactly right. Deshawn will end the depreciation of his rental house when either he sells or otherwise gets rid of the property, or he stops using it for rental property, or when there's no more basis to depreciate it. In other words, he fully depreciated the property. And guys, all this you already knew because we've already gone over basis and depreciation. The reason I keep saying, even though like someone said, it kind of is a little foggy, of course it is because you're not real used to it. We just introduced you to it a few sessions ago. But you'll notice we keep coming back to the same thing. It's the same information over and over again. Let me share with you something. When it comes to tax law, look for the patterns, look for the repetitions, because a lot of tax law is saying, here's the general rule, and we're going to apply it to here. Then we're going to apply it to here, and then we're going to apply it to here. They're applying it to different situations over and over again. Now, the depreciation basis for residential property is its cost or adjusted basis. What is adjusted basis? Again, this is a review from when we talked about basis and depreciation. Adjusted basis is determined by adjustments that occurred before the taxpayer places the property in service. For personal use property that's changed to rental use, like for instance Garrett's example where you own the house and then you decided to move out and convert it to rental use, the basis for depreciation will be either the fair market value or the adjusted basis, whichever's less. Now, I'm wording it differently than they have here, but it's the fair market value or adjusted basis on the date the property is placed in service, whichever's less. So let me give you an example of above here. Depreciation basis for residential property is its cost or adjusted basis. So if I buy property for $50,000, let's say I buy a house for $50,000 and I make $10,000 worth of improvements to it, what is my depreciable basis? What's the, well, actually, let me just ask you this. What is my adjusted basis in the house? Bought it for $50,000, did $10,000 worth of improvements. What is my adjusted basis in that house?
60,000.
60,000. That's right. What's my depreciable basis? Remember that term? It means how much of that can I use for depreciation?
60,000.
That's right. And why is it that way? Because I did not start until I finished. I bought the house and then made the improvements and then started renting it out. So I did not place it in service until after I did the improvement. Let's say though, let's change the circumstances a little bit. Let's say I bought that house for $50,000. I got a renter in there and then I decided to add on a room and that cost me, in other words, I made an improvement for $10,000. What is my basis in the house when the renter moved in?
50,000.
That's right. So what is my depreciable basis in that house?
50,000.
That's right. And then I made a $10,000 improvement. What's my total basis in the house? Total basis.
60,000.
That's right. But what is my depreciable basis in the house?
Well, you depreciate the improvement made separately from the
That's
date.
exactly. So you have actually two different depreciable bases. You have a depreciable basis for the house, which is how much?
50,000.
And then you have a depreciable basis in the improvement, which is how much?
10,000.
10,000. You see how that's different though? It's all based on when I placed it in service. If I already had it in service before I made the improvement, I do the improvement separately. Otherwise, depreciate it separately. Otherwise, I depreciate it as a whole if I do it before. That's all that's talking about. Remember, land has no depreciation basis.
Yes.
Permanent land improvements are not depreciable. And if you do make a land improvement, you just add it to the basis of the land itself. Okay? That's all you got to remember. Depreciation methods. We've talked about this. Use the general depreciation system, specifically the makers. Remember, I keep saying makers is part of the general depreciation system. Rental property will fall into one of these property classes, either 5-year property, 7-year, 15-year, or the 27.5-year. Residential rental property, when you see that, they're talking about the house itself, the real estate. That's always 27.5 years. If I buy a rental property house and I rent it out, how many years do I have to depreciate it?
28.
No, we don't round there. It's actually 27.5. You're not wrong, but that's a rounding, and that can get you in trouble with depreciation. It's actually 27.5. Okay, that's all. So, all right. So residential rental property, 27.5 years. If I make an improvement to the real estate that's there, if I add on, if I put a new roof on there, how many years do? First of all, it has its own separate. I depreciate that separately. How many years am I going to depreciate that new roof?
27.5.
That's right, because remember, there's the rule that says if you improve the property, it takes the recovery, it adopts the recovery period of the property that you're improving. The easiest way to think of it is a residential rental house, 27.5 years recovery period. If you make an improvement to that house after it's been placed in service, you take the improvement and adopt the recovery period. You can have 5-year period, 7-year period, or 15-year period when it comes to depreciation. That's all. And you guys already have seen some of that. Okay? That's just the recovery period. This is actually out of one of the tables. I'm not going to have you worry about that. Improvements made to rental property, we just talked about this. They're treated as a separate asset. You depreciate it separately. What is an improvement? It adds to the value, prolongs the life, or adapts to a different use. We already talked about that earlier. And we just talked about this. Recovery period for improvements. It always, the property class and recovery period of improvement is the one that would apply to the original property. That's what we were just talking about. Okay? So you can see we're just kind of repeating ourselves here. So here's an example. Misha bought a rental house 6 years ago, and she replaced the roof this tax year. The new roof is a depreciable asset separate from the rental house. Why is it? Because she bought the house, put it in service, and then made the improvement. The recovery period for the roof is going to be the same as it would be for the house, 27.5 years. But she put the house in service 6 years ago. She put this in service just this year. When Misha files her tax return for this year, the rental house will be in its 6th year of depreciation, and the roof will be in its 1st year of depreciation. Now, if Misha had just repaired the roof and not replaced it, would it have been a repair cost, or would it have been depreciated if she had just repaired a part of the roof rather than replacing it?
Repair.
Deductible is an expense.
That's
Yes,
right.
it's
Deductible. That's exactly right. Deductible is an expense, as a repair expense to be exact. Okay? Guys, we've already talked about date.
Excuse me, James.
Yeah.
About your example, you said the house is on the 6th year, right? and it is depreciable 27.5 year. The roof is on the 6th year. So it is depreciable until the end of the depreciation of the house.
No, no, it
Still
takes the same.
27.5.
That's right. That's right. But see, even though it's an improvement to the house, the improvement is treated as a separate thing. It's depreciated for 27.5 years. That's why this bulleted point that I'm circling here on the screen, if you can see it, is important. Because in this example, Misha is on her 6th year of depreciation for the house, but 1st year of depreciation for the roof.
So you mean the house will be fully depreciated first?
Yes, that's right. That's right.
Okay.
It'll end up being, assuming she owns it and keeps using it for depreciation, the house will be depreciated completely before the roof is completely depreciated. That's exactly right.
Okay.
Okay. And I'm not stopping to talk anymore about when placing things in service. I've already explained that. Let's talk about special considerations for depreciation, because remember we talked about Section 179 deductions and the special depreciation allowance of 50% or 100% depending on when it's placed in service. Section 179 deduction. Can you ever use Section 179 deduction for any kind of rental?
No.
No, you can't. It's okay. We talked about it. I don't expect you guys to remember everything. That's why they repeat it. The easy way to remember this is on the left-hand column here. You're seeing residential rental property. Again, I want to stress what they're talking about is the real estate. Then assets used in the property. That would be like a refrigerator, stove, washer, dryer, things like that. So any kind and all kinds of rental property, you could never Section 179 any rental property in any fashion, whether it's real estate or personal property that's in there, personal assets that's in there. That you can never Section 179. So this one's easy to remember. Special depreciation allowance. You can never take special depreciation allowance for real estate rental, but you can for rental personal property or rental assets that are not real estate. Okay?
Or like a dishwasher or
Yes. Yeah.
something like that.
So if you bought it, let's use that as an example, Garrett. Let's say you bought a dishwasher for $500 to put in a rental because the old one went out. Okay? You cannot expense that because that is an item that lasts longer than a year.
Yes.
So the first thing, remember the order of events for any depreciation. You start with, can I Section 179 it? Well, is this going into a rental? Yes, it is. Since it's going into a rental, can I take Section 179 for that $500 for that dishwasher?
No.
No, you can't, because you can't Section 179 anything that's rental. Excuse me. Now, after you think about Section 179, then you think about special depreciation allowance. Well, is the dishwasher going into the rental, is it real estate?
No.
No, it's not. Is it rental personal property or a rental asset?
Yes.
Yes.
So can I take special depreciation allowance for that if I choose to?
Yes.
Yes. So I can choose to take it or not take it. If I placed it in service in 2018, what percentage special depreciation allowance can I take? Now, this going back to the depreciation in this, we're just recapping, reviewing. How much can I take?
So would it be a 7-year?
No. Well, no, I'm not saying you're wrong. I'm not even looking at that. What I'm saying is we're only talking, remember, when you're talking depreciation, you decide Section 1, can I and do I want to take Section 179 deduction? If I can't or don't want to, then I look at special depreciation allowance. Can I take it and do I want to take it? And if I can't or don't want to, then I go into regular depreciation. Remember to take it in that order. Section 179, then special depreciation allowance, then regular depreciation. So what you were getting at is, what is the number of years property, you know?
Mhm.
Is point taken, but I'm not even there yet. I'm
see.
still looking at special depreciation. So my question is, if I buy a dishwasher for a rental, my rental property, is that a personal, is that an asset that qualifies for a special depreciation?
Yes.
Okay. So now, if I bought that in 2018, what percentage can I choose to take if I choose to take special depreciation?
Isn't it 50%?
Yeah, 50%, half year.
I'm not sure. So
It's okay. Do you remember? No, you got. That's okay. Don't make this complicated. What is the depreciation, special depreciation allowance for year 2018? What is the percentage that's allowed?
100%.
It is 100%. Do you remember that date in 2017 where if you bought it before 2017, excuse me, if you bought it before that date, it's 50%, and after that date, it's 100%.
Yeah.
Just remember September.
Members.
Yeah, September. Look, September is close
28th,
enough.
2017.
Yeah, I be honest with you, I forgot the exact date. Amanda guessed September 17th. I think it was the 27th. I've even forgotten right now. It's not that critical. What's important is
100%.
if you know by the time in 2018 that you're into 100% special depreciation allowance. So I could potentially take 100% special depreciation allowance for that. Now, I can either do that or I can choose not to do that. If I don't do this, then I move into just taking regular depreciation.
Regular.
Yeah, that's right. Does that make sense?
Mhm.
Okay. Vacant property. If you, let's say somebody moves out and you lose some money because you don't get the income for a few months, that loss of rental income due to a vacancy is not deductible. But any expenses you're incurring during that period of time to fix the house back up, that's deductible. Okay, so you don't get to include loss from income just because it's vacant. So Julie owns a condo that she rents out for $850 a month. If the condo is only occupied for 10 months, she cannot take a deduction for the loss of rent for the time the condo is vacant. Instead, she'll just report the amount of income that she actually received for the 10 months she rented it. That's going to be $850 times 10 months, gives us $8,500 of rental income. But during those 2 months that the condo is vacant, she's still able to fix it up and take any of her ordinary and necessary expenses with the property, such as what it cost her to fix it up, such as the real estate taxes she's paying, such as any mortgage interest she might be paying. And of course, she can take the depreciation. Why? Because it's still in service. It's just in a transition between one renter to another renter. That's all. Property changed to a rental use. We've mentioned this a few times. Taxpayers can change their home from personal use to rental use. And in the year that they do that, they just have to divide up the costs between personal use and rental use. That's all I want to get into there. And I'm going to skip over that example. Okay, so we've got some knowledge checks. Which of the following is a rental expense that is fully deductible in the current year? Here are the options in case you can't see it yet. Cost of the rental house, cost of improvements, lost income due to vacancy, or cost of repairs.
Can you repeat the question?
Which of the following is a rental expense that is fully deductible in the current year? Cost of rental house, cost of improvements, lost income due to vacancy, or cost of repairs? So the answer is cost of repairs. You guys got that right. You can fully deduct the cost of repairs, but the cost of a rental house, that's real estate.
Oh, yes.
You depreciate that. Cost of improvements, that's something that's going to last longer than a year. You depreciate that. Lost income due to vacancy, do you get to include that as an expense?
No.
No.
Oh.
No, you just don't include it in your income. Dan purchased a house. Here's the next one. Dan purchased a house for $200,000, which includes a land value of $35,000. Before he placed the house in service as a rental, he added a bedroom, which cost $5,000. 3 months after he placed it in service, he added a bathroom, which cost $7,000. How much is Dan's basis for depreciating the house? So do your best to come up with an answer, and then we'll go through it together, okay? So all we're simply saying is how much do you put down on the tax return as adjusted basis for the house for depreciation?
Oh,
$177,000.
Okay. I'm letting everyone try to do an answer here.
I changed my answer.
I saw that. Okay. All right. So I'm going to tell you what the answer is. Oops, if I can get it to advance here. My slide to advance, that'll help. There we go, $170,000. How do we get to $170,000? Let me just walk through it with you. First of all, do we get to depreciate land?
No.
No.
No. So if the whole cost of the house, including the land, was $200,000, we have to subtract out the land value. 200,000 minus 35,000 leaves us with what?
165,000.
Right. Now, before he placed the house, let me ask you this. Now, any improvements you make to property before you place it in service gets added to the value of the land. The value of the house, I mean,
Yeah.
I'm sorry. Any improvement that you make after you place it in service gets depreciated separately. So before he placed the house in service as a rental, he added a bedroom that cost $5,000. So 165 plus 5,000 gives us
170,000.
170,000, and that's how we get at the answer. Let's look at the rest of the problem though. 3 months after he placed it in service, he added a bathroom that cost 7,000. Is he going to, let me ask you a question now, is he going to expense the $7,000 or depreciate the $7,000?
Depreciate.
Depreciate.
And why is he depreciating it?
Improvement.
It's an improvement. That's right. And you depreciate an improvement separately if it's placed in service after, if it's placed in service after the house was placed in service. Okay? That's all.
Yes.
All right. So let's look at the next one. Alyssa lived in her home until June 30. She began renting her house to a tenant on July 1. She had the following expenses for the year: insurance of $400, mortgage interest of $4,500, real estate tax of $2,000, and a new sprinkler system of $1,200. How much can Alyssa deduct for rental expenses?
Is the sprinkler system considered an improvement?
Well, have a discussion on that. What do you guys think?
I would think an improvement, but
It is. It's an improvement, guys. A new sprinkler system is not a fix. A fix would be the head on one of them. You all are right. Everybody's answered the same thing. Okay. Okay, so far I have two people's answers as far as what they can deduct. Okay. All right. So I want you to know that 3 of the 4 of you actually got it wrong, but there's a reason, because you're forgetting to do something.
Huh?
So let's go through this before I give you the answer. Let's work it through together. So first of all, which items can you include as an expense? Can somebody tick them off for me? Just tell me what they are.
Insurance, mortgage interest, and real estate tax.
That's right. And when you add that up, you get how much?
6,900.
6,900.
6,900. That's right. Now, 3 of you said 6,900. Why is that not the correct answer?
Because you have to divide it by 2.
Remember, she converted her home in the middle of the year. So at the end of the first half of the year, she was living in her home the first half of the year. And then she began to rent it the second half. So she can only take half of those expenses for the second half of the year. That's why. So what's half of 6,900?
3,450.
3,450. That's why that's the answer. Remember the rule that says if you convert something from personal use to business use or back or rental use, or the other way around, from rental to business, rental to personal, you have to make an adjustment for the personal use part and rental part. Let's look at a different situation. Serena bought a replacement dishwasher for her rental property on April 4. It was installed on May 1st. Which of the following is true about the dishwasher? The date here, A, date depreciation begins is April 4. The dishwasher, B, the dishwasher can be expensed under Section 179. C, the dishwasher is depreciable property with a 5-year recovery period. Or D, it is considered a repair that can be expensed in the current year. Go ahead and give me your answers. Waiting for 2 more people to throw in their answers, if I'm not mistaken. It's sometimes hard for me when you type it in. I can't tell which question you're answering necessarily. Okay. Here's the answer is the dishwasher is depreciable property with a 5-year recovery period. So let's walk through why the others are not. Date depreciation begins as April 4. Why is that not accurate? Can somebody tell me why that's not true?
Because it was installed on May 1.
That's right, which means that's the date it was put into service in this situation. Right, exactly. Correct, Amanda. Okay, the second one is that dishwasher can be expensed under Section 179. Why is that not correct?
Wrong answer. Not applicable.
We know it's the
Because
wrong
it's
answer.
rental.
Why is it the wrong answer? That's right, Amanda. It's not rental property. You could never, that's not what I meant to say. You could never depreciate, Section 179 rental property.
Rental property.
Correct.
But she put never rental property, and that's true. You could never depreciate. I keep saying that wrong. I apologize. You could
Can't
never
do Section
Section 179 rental property.
Yeah.
Yeah. I knew what you meant, and I understood that, Amanda. I just kept saying it wrong. It is considered a repair that can be expensed. Why is that not correct?
Well, that was what I was not sure on, but she replaced the original dishwasher, so I wasn't sure. I was looking at the 5-year, and that, so I went with these.
Right, but you got to remember, one of the major, most basic differences between a repair and an improvement is, are you just increasing the life to beyond a year, or are you putting something in service that's going to last longer than a year? It is a little bit tricky, because let's say you just have a broken pipe, it burst during the winter. You went in and cut out a piece and put a little little patch in there. Well, that's probably going to last longer than a year too, but why is that a repair? Because you haven't really done anything significant to it. You just got to kind of consider any item you buy like this always to be an improvement of a type. It's not really an improvement either, to tell you the truth. It's simply an item you put in there. Let me put it this way. If you had a dishwasher and you sent a repairman in to fix the hose on the dishwasher, that's a repair that's fully expensable. But buying a brand new dishwasher is a complete replacement of it. I am not going to read that out loud. Everyone can read in the chat box what she wrote.
Yeah, well, it just says she bought a replacement in case she bought a new one. So, but
Right, that's why. It's all good. It's all good. I'm just laughing about it. Okay, John bought a rental property and placed the following assets into service this tax year. Okay, so he bought rental property, he bought it as rental property, and he put these assets into service. The rental house for $125,000, which does not include any land value, bought that on April 2nd. Refrigerator for $850 on June 1st. Carpet for $2,200 on July 26th. What is John's depreciation deduction for his rental property, assuming that the special depreciation allowance is not used? Guys, I'm going to have you jump over this. This requires you, I'm going to give you the answer. The reason I'm having you hold on is, no, it's not that. It's not that you can't figure it out. It's that it's not worth the amount of time it would take. You're going to have to get into depreciation tables and calculate some of this.
yeah, that's what I was thinking.
I'm skipping over it because I don't want to take the time. I wish we had more time. I wish I wasn't rushing a 10-week class into a 5-week class, because then I'd take more time with this. But guess what? Again, the nice thing is you're not going to be asked to calculate it with this kind of detail on the IRS exam. You're just not going to be asked. They're going to be asking, if they ask you to calculate something, it's going to be more like what we already did, where the information's easily and quickly available to you. Okay. So let's look at this, reporting income or loss. Schedule E is where you report income or loss. Now, did we do a Schedule E just at the beginning of this session? Yeah, we did. You see, it's not that hard. What, though, if, remember on there was a place for property A, B, and C. What if you have more than 3 rental properties? Well, just complete and attach additional Schedule E to list all your properties. That's all. Married taxpayers who file MFJ, in other words, jointly own a real estate business, are considered a partnership. Remember us discussing that. But they can choose to be treated as a qualified joint venture. What's the real benefit in this case of them doing a qualified joint venture? The real benefit is they don't have to do as a partnership. They would have to do a partnership return. They can bypass a partnership return if they're doing a qualified joint venture. And in a qualified joint venture for a rental, they're actually just reporting everything together as if they were one person for the rental purposes. If you, in contrast, remember when we talked about self-employment, you could have two people doing a qualified, husband and wife doing a I keep saying that wrong.
Separate return.
Yeah, you could do a husband and wife can be sharing a business together, and again, they would be treated as a partnership, but they can do a qualified joint venture. How would you report that? Do you remember how to, on a business income, a self-employment income, how would you do a qualified joint venture on that, on a tax return?
Separate Schedule C.
That's right, separate Schedule Cs. So if it's a self-employment joint venture, husband does a Schedule C and takes part of the income and deductions. Wife does a Schedule C and takes the other part of the income and deductions. And then it gets added together and put on the Form 1040. But when they do a qualified joint venture for Schedule E, it just gets all added together onto one Schedule E as if it was just one person.
Okay.
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 Form 4562, that's the depreciation and amortization form. There's only 3 situations where you need to use the 4562. You need to use it when you're depreciating property that was placed into service in the current tax year. So the first time you use it is the first year you're depreciating property, you have to do a 4562. Or when you're depreciating listed property. Remember what listed property is? My definition of listed property? Somebody tell me.
Easily use and abuse.
That's right, easily used and abused. That's exactly right. So if you have listed property, it doesn't matter what year it was placed in service. If you have listed property that you're depreciating, you have to always do a 4562 for each year you have listed property. Or any auto expenses, regardless of what year you first started using the auto, and whether or not you're using actual expenses or standard mileage. So you only have to use a 4562 in the year you first place a property into service for depreciation, or every year that you've got listed property, or every year you have auto expenses. That's when you use 4562. You should always do a depreciation worksheet. That helps you document and keep track of what you've taken from year to year. And that's really all I want you to be worried about. I'm going to skip over this here. I don't think you need to get into it. We've kind of covered this and recovered. I just want you to see, here's a depreciation worksheet. You're able to see this person has a townhouse. In fact, you know what? You guys look at it. I'm going to ask you some questions. You can, in real life, you would do this. If you could get a hold of let's say a brand new client came to you and you needed to include this plus this year's stuff in their return. If you had this, you have everything you need to do their return as long as you got this year's information. So what 2 items is Justin depreciating?
The house and the refrigerator.
The townhouse and the refrigerator. Let's talk about just the townhouse for a minute. When did he place it in service?
6/1/16.
What was his cost basis in the townhouse?
$100,000.
100,000.
What's his business use percentage?
100%.
How much Section 179 expense did he take?
None.
0.
That's right.
Not a lot.
How much special depreciation did he take?
0.
So what's his depreciable basis?
$100,000.
Okay, and that's what's subject to depreciation. So what's the recovery period he used for the townhouse?
27.5 year.
What's his method and convention that he used for depreciating?
Mid-month.
Straight line.
Yep, that's right. Recovered prior years. That's blank. Technically, that should have been filled in there a little bit, but we're not going to worry about it. So, looking for the 2016 part of the depreciation of the townhouse. What percentage did he use in 2016, and what was the actual amount he depreciated in 2016?
1.97 and 1970.
Yep. Does everyone see where that's at?
Yes.
So for 2016, there's the percentage. Where did he get that?
The table.
From the table. That's exactly right. And the actual amount he took was $1,970. Same question for 2017. What was his depreciation percentage for 2017?
3.636.
And how much did he actually take in 2017?
36.36.
Perfect. So how much total, and by the way, this is for 2018, which that's what you're working on now. That's where you'd put 2018 amount. So when you go to do your 2018 amount, how much has already been depreciated up to in 2016 and 2017?
$5,606.
I'm having to do the math too because I don't have it.
5607.
Yep, 5606.
5606.
Yeah, 5606.
06, sorry.
Yeah, that's okay. But that's how that works. See how beneficial, why we say do a depreciation worksheet? It really helps you. You got all the information. All you'd have to do now with all this information is now you could calculate the next year's because you know exactly when to start depreciating in a table. You know exactly what was already depreciated. You already can figure out, oh, I should ask this. We know 5606 was taken on this. What's his remaining depreciable basis? I had to do it too, so.
94,394.
Yep, you all have the right answer. I heard everybody answer that. In other words, we're taking the depreciable basis minus the amounts that were already depreciated. That's what's left is $94,394. You see how all the information is right there for you.
We'd be taking $3,432 this year.
Oh, he might be. I'm sorry. I'd have to do the math on all of this. So, because I don't, I'd
It's the
have to
same
look.
percentage, 3.63.
Oh, that's right. Yeah, that's right. For several years in a row. You're right. So you
But
take.
so with the amount we just figured, that's where I come up with 3432. So
Yeah, no, you're right. I didn't think about that. Times 0.03636. So all he did is he took what the remaining amount of depreciable basis is, and he multiplied it by the percentage. So we're good. Don't worry about all that, guys. So we're good. We're into that. That's all I wanted you to see. And then that's the depreciation worksheet. Then you got to plug the numbers in here right. The amount that's being taken for everything. You got to plug it in here. So this is something that he placed in service that he's adding in. Here's his previous maker's depreciation, so on. That's the, so you see the previous amount is reported there. There's the there's additional amounts. So it's, you just work your way through the sheet. Why am I jumping over this? The sheet, this worksheet, excuse me, this depreciation and amortization form, it's really important. But while I want you to know what's there and how to deal with it, it's much more important for sake of passing the test that you understand the concepts. And to have you know how to fill out every single form by hand is not as critical. It is important that you understand a little bit about it. So anyway, that's it. That's all I wanted to share with you on that. And then from the schedule 4562, you carry that amount to this year's depreciation on the schedule E. And then you end up with an amount that's rental income and or loss. And the rental income in this example is $1,534, and that gets reported on the Form 1040 as income under rental real estate. See? And that's how it gets into there as taxable income. Now, guys, we already talked about the at-risk rules and the loss limits, right? Do you remember that?
Mm-hmm.
So I'm removing it so you can't see it. Somebody tell me what the at-risk rule says. If you have a loss, if you have a rental loss, what does the at-risk rule say?
you can't deduct a loss that's any more than the amount you have at risk in the investment of the property.
That's right. Exactly. So if I only have $1,000 at risk, what's the maximum loss I can take?
$1,000.
$1,000.
That's right. All right. At-risk rules. What are the loss rules say? The passive activity limits say. I was using the wrong term. What does the passive activity loss rules say? Anybody remember that one?
Oh, I was waiting for somebody else. Passive activity is you can't deduct a loss unless you have an investment in there of some amount. I believe it's 20 or 25,000 invested.
Okay. Wait, you're too deep in. You're right, but you're too deep into the rule. That's an exception to the rule. What's the general rule on passive activities?
You can't deduct any loss.
That's right. There you go. That's what I was looking for.
Okay.
You cannot deduct a loss of a passive activity. Is rental considered a passive activity?
Yes.
Yes. Unless you have some sort of involvement in it. So.
You are
Unless you have some.
actively
That's right.
Yeah,
Active
unless you're
participation.
actively involved.
Unless you're actively involved in the process, and then it's still limited, but it's limited to how many dollars a year?
25,000.
25,000.
Exactly right. So, two other things I want to throw in there on passive activities, okay? First of all, if you have two rentals and one of them has a loss of $5,000 and the other has a gain of $15,000, well, actually, can I change that example to make a better point? We know that you can take potentially up to $25,000 of rental expenses. So let's say you have two rentals, you're actively involved, so you could potentially take up to $25,000 of a loss as an expense. Okay, you could actually take that. But let's say you have two rentals. One of them has a $30,000 loss and the other has a $50,000 gain. Can you take all $30,000 of losses?
No.
You can deduct it off of your income, can't you?
It's okay, guys. This isn't meant to be a trick question. It is a tricky question, though. Yeah, you can, because part of the passive activity limits say you can offset one passive activity loss with another passive activity income. So you have two rentals. One of them has a big enough income to offset the loss. So you can, but you would, because remember on the Schedule E, everybody look at your Schedule E for a second that we did.
Mhm.
Remember down there on line 23, it started adding everything together, 23A, B? That's why it's doing it. It's trying to put everything together so we can see if by the time you add it all together, do you have a loss or a gain?
Mm-hmm.
So the loss of property A might be offset by the gain on property B. So far, does that make sense?
Yeah.
So you mean you can deduct 30 from 50?
Yeah, in that example, you could, because let's say on the Schedule E, which I'm looking at right now, the Schedule E for rental, let's say I had two properties. I had a property A column and a property B column. Property A column maybe has a loss of $30,000. Property B column has a gain of $50,000. Well, when I add that together, what's my overall gain or loss from my passive activity in rentals?
Gain of
20,000.
20,000. Where would that get reported on the Schedule E? Everybody look at your Schedule E. Where does that get reported?
23A.
Well, well, look at the bottom. What I'm really trying to get you to is the
26.
bottom line.
24.
Line 26.
26, yeah.
Yeah, it's all added together. So what I'm trying to point out here is these at-risk rules, they start applying after you get to line 25, actually. That's it. That line, look at line 25. That's for the total loss if everything added together results in a loss. Do you see in that?
Mm-hmm.
Okay. So what we're saying is you got to get all the way through the bottom line or line 25 and end up with a loss on line 25 after you add all of your passive activities together. If you have a loss then that's when these rules kick in. They don't kick in individually. They kick in as a whole. Does that make sense what I'm talking about?
Mm-hmm.
Yeah. That means if you have two rentals, make sure to add it all together and find out between the two rentals as a whole, did you have a loss or a gain? You might have had a gain just because you had a loss on one, but a bigger gain on the other. But if you did have a loss after you add it all together, then you apply the at-risk rules and the passive activity rules. Okay?
Okay.
Now, remember we said if you participated if you actually actively participated in the rental real estate, you could potentially claim up to $25,000 of the loss. Well, what does it take? Here's the rules for what it means to actively participate. You had to have owned at least 10% of the property. And if it's an MFJ, you can get to 10% by you're adding your part with your spouse's part. As long as if you and your spouse together on an MFJ return own at least 10% of the property. So you do have to own 10% of the property. You had to have been involved with making significant management decisions. For example, approving new tenants, deciding on rental terms, approving expenditures, and so on. Taxpayers who file MFS and lived apart all year long from each other, they can take a special loss allowance of $12,500. Why is that? Why is it that amount?
25,000 divided.
Yeah, it's half of 25,000.
Yeah, because each of them get to take half the loss. But that's it. What if they're MFS and live together? How much do they get to take?
0.
0. So another disadvantage of MFS, if you're living together and file MFS, you can take no loss, even if you are actively involved on this. But if you're living apart and are MFS, you each can take up to $12,500. That's all. I'm not going to worry about the examples there because I think that's common sense for you guys. So let's look at knowledge check 3 here. Taxpayer should complete Form 4562 for rental activity if they are claiming all but which of the following. And I'm not going to read all this to you. So I'm sorry, Noemi, I'm going to have to either let it come through or we're just going to it's a bunch of words. It would be too confusing. So go ahead and type in your answers, A, B, C, or D.
Oh, all but.
Yeah, all but. That's right. Remember, we went through a list of the 3 situations where you must use a Form 4562. We're looking for the one that's not part of that list. Oh, I see. Noemi, yours must have come through. Okay, so here's the answer. C, depreciation on property placed in service during a prior year. So let's go through the ones that are required. It's the other 3. It is required when you're placing property in service for depreciation in the current year. In other words, it's the first year that you're placing property in service. You have to use Form 4562. You must use it on any year you've got listed property that you're depreciating. And you must use it on any year you've got auto expenses. Okay?
Mm-hmm.
Okay, rent. Oh, this is going to be fun. You're going to have to use your Schedule E to answer this. Rent from residential rental property is reported on which line of Schedule E? That's correct. Line 3. Good job, because that's your rental income line. Kent rented out a residential rental property for 11 months. Where are his income and expenses initially reported, and then to where is the total income or loss reported? So where does he first report it and then carry it to what?
Schedule E.
Now, at one of my early sessions, I actually gave you guys a copy of the Schedule 1 and everything. Okay, so let's do this one together. First of all, where do you initially report rental income?
Schedule E.
E.
Schedule E. So we already know that the first two cannot be the answer. Then where do we, once we figure it out on Schedule E, where do we report it? Which form do we carry it to?
Schedule 1.
1040.
And 40.
Of Schedule 1.
Yeah.
Mhm.
So we already know we're down to C or D. We just need to know which line do we report it on. Does anyone have a Schedule 1 in front of them to look at? It's okay, guys. I'm going to give you the answer. It's okay. No one does. And be honest with you, I don't care that you remember this. What is important is that you remember you initially reported on Schedule E, and then it goes on to the Form 1040 Schedule 1. That's what I do want you to remember. Okay?
Mm,
Schedule E, and then from Schedule E to Form 1040. Okay? That's what I want you to remember for testing purposes.
Oh, it says that on 26 at the very bottom of the Schedule E. I just saw that. So.
Yeah.
It said line 17. Okay.
Yep. Actually, I forgot it was on there. So good catch, Garrett. All right. Joshua is filing a single. He has total rental real estate losses of $35,000 from an activity in which he actively participates. He does not have any passive income. First of all, just before we go any further, why is that statement important? He does not have any passive income.
Because the maximum was
Offsetting.
25.
No, I forgive me for laughing. It's because that's why I stopped and talked with you guys about you can offset one passive income with another passive income. They're telling you he has no other passive income to offset this loss. That's what it's telling you. Okay. Remember that?
Mhm.
Yeah. Okay. So that's why I just pointed that out to you. That's not going to help you with this answer other than no, he doesn't have any other. So he has $35,000 loss in activity. How much can he actually deduct in the current year of that loss?
25,000.
That's exactly right. 25,000. So guys, what we've done is we've actually gone through everything, the extra details about rentals. Now, here's the nice thing. Everything about rentals, we've gone through so much, I guarantee you, if you knew what was there, you're not only going to pass this part of the exam, you're ahead of the game because guess what about rentals? That's not highly tested in Part 1, I understand, with the EA. But it's good to know it because it helps you understand the bigger picture, and that way any occasional question that might come up about rentals, you'll have the answer to. So I want to make one other mental shift that I would like you to make one other mental shift if you can, okay, for the rest of this session. And I know you want to take a break, but I'm going to ask you to stick with me because we only need a few more minutes to get through this. There's a thing called a flow-through entity. Why am I bringing it up now? The Schedule E, do you guys have page 2 of the Schedule E or just
Yes.
page 1?
Yeah, a couple.
What do you see on page 2 of the Schedule E?
Part 2, income or loss from partnerships or S corporations.
There you go. The reason we're covering it now is because Schedule E is not only used for rental activities, that's page 1, but it's used for what we call flow-through entities on page 2. And that's what this lesson is about.
And estates and trusts are Part 3, it says. So
That's
also covered.
That's right. That's right. So it's all on there. Now, so we're talking about flow-through entities. I'm going to define that, and I do ask you to stay alert for 10 minutes, and I guarantee you we're already going to be done with it. This isn't complicated. Okay. First of all, a flow-through, also called a pass-through entity, includes partnerships, S corporations, estates, and trusts. In Part 2 of the EA, you're going to be learning details about all of these and how a partnership calculates things, how an S corporation calculates things, how an estate and trust calculates things. You're going to be learning the details of it. But what does flow through mean or pass through? It means that they pass through any profits or losses directly to the partners or the shareholders. Now, partnerships have partners. S corporations have shareholders because they're a corporation. They have people with stock in the corporation. They pass through profits and losses to their partners who put that information on their own individual income tax returns. In other words, it goes right past the partnership or S corporation as if that didn't even exist. What is that similar to that you've already learned about? What other business or a type have you already learned about where you do that, where you put your own profit and loss directly on your return?
Self-employment.
Self-employment.
Self-employment. That's right. You do a self-employment Schedule C. Well, guess what? If you're a part of a partnership or S corporation and you have a pass-through profits or losses, you're kind of doing the same thing, except you're doing it on page 2 of the Schedule E as an echo that what we've been looking at here. Does that make sense? What this is? It's just passing through. If you have a regular C corporation, now I know this is a little bit extra detail, but it'll help you understand the difference. If you have a regular corporation, Nike, for example, that's a regular corporation. Can you buy stock in Nike?
Yep.
Sure. Yeah. Does Nike have to do its own? Nike, I'm talking about the corporation. It is, in the eyes of the law, considered a separate human being, just like you are individually. So in the eyes of tax law, Nike has to do its own corporate tax return, just like you have to do your own personal tax return. When Nike does its tax return, it has to pay income taxes on its income, right?
Mm-hmm.
But, and so it's getting taxed there, and then it passes on dividends from its profits during the year to the shareholders, right? Mm-hmm. Remember all this? The income that you earn that's generated during the year by a corporation is passed as dividends through. Well, when you as an individual get dividends from Nike because you've invested in it, are you going to get taxed on those dividends?
Yes.
Yes, you are. So, has the IRS successfully taxed twice on the same income?
I guess so.
They certainly have. They've taxed Nike on the income that it earned, and then it taxed you on the dividends you earned, even though it all came from the same income. That's double taxation. It is completely legal, but this is one of the benefits of a partnership. You don't get double tax because while you have to do a partnership return, you report it in a way that it passes through and doesn't get taxed by the partnership. It passes through to the partners who put the information on their return, the income on their return, and their expenses. An S corporation is a special type of corporation that has the same benefit. They do a tax return, but they don't get taxed at the corporate level. All the income and expenses come through to the partners, to the shareholders, and it gets taxed there. No, so the question is so Nike would not get taxed on that because they pass it through to you? No, that's not correct, because Nike is not an S corporation. It is a regular C corporation that does get taxed. That's why I was using Nike as an example. So a regular when you think of a corporation, most people are thinking of what's called a C corp. Okay. And by the way, the letters S and C, that just stands for, in the law, if you were to go to it, subsection S or subsection C. It's just talking about a section number where it describes that type of corporation. A regular corporation, most people think, they think of a corporation, they're thinking of a C corporation. They get taxed at the corporate level when the corporation does its tax return, and then the individuals who get some benefit from that get taxed also. Partnerships and S corporations bypass that. All the income and deduction items flow through or pass through the tax returns to the individuals who put it on their return. Now, flow-through entities use a Schedule K1 to report the partners or shareholders' portion of income, deductions, and credits. So Schedule K1 is simply similar in some concepts to a W-2 in the sense that it's giving you information about your income from this partnership or this S corporation. And they must provide each taxpayer with their own Schedule K1 for each activity. And all that means is if you're invested in a S corporation, when the S corporation does its tax return and figures out what its income net profit was for the year and its expenses were for the year, it has to report that on this K1 and then give one for you, Garrett, because you've invested, one to you, Amanda, because you invested, one to Sheila, and so on. Every person that's invested gets a K1 to find out what part of that income and deductions belong to you. And then you report it on your tax return. Part of it, look, there are different places you report as K1. It depends on what's been reported there. But generally speaking, generally K1 income, you report on your personal income tax return on page 2 of the Schedule E. Okay? So, as you see on the screen, this K1 is used to report information much like a Form 1099 is. You get a 1099, you know some income is there, you got to put it on your own separate tax, on your own personal tax return. Partners and shareholders are liable for income tax on their share of entity income. We've already said that. So if you're 50-50 with a partner, you get half of the income and deduction, half of the income, and you get half of the tax liability too. But you figure it individually with your own personal taxes. Each partner or shareholder treats their share of partnership income as though they were a sole proprietor. Okay? And then income or expense items that are subject to limitations at the Form 1040 level must be reported separately. All we're saying is, remember all the rules for self-employed, that there are some limitations that you got to apply to things like Section 179 and so on. All those things, they got to report to you individually because you have to apply it at your individual level. So, for example, there's a Section 179 deduction is limited to the total of all your taxpayers' business activities. So if you have, you can remember Section 179 deduction, one of the limits is your income limit. How much net profit do you have from your business? Well, you as an individual just got a Schedule K from an S corporation. If there's Section 179 deduction on there and it's more than the amount of income you got from the business, you cannot use all of your Section 179 deduction. Why? Because think of it as if you're self-employed. If you had less self-employment income than you did deduction, you can't use it all. That's why they have to report the Section 179 separately on the Schedule K1 so you can figure out how it applies to you. Income and losses from K1 are generally reported on Schedule E, page 2, which I've already said, and then carried to the Form 1040. Okay, so before I go any further, there's just only a couple more items I quickly want to cover that relate to this, and then we'll be done with this. Any questions on that? This is a little bit new, but it's not completely new to you. It's just a flow-through entity. This is similar to self-employment, except you report your basic income and losses on a Schedule E, and that eventually flows into the Form 1040.
So you mean S corporation is not the same to C corporation?
That is exactly what I'm saying. Yes, that's correct. And, you know, I really don't want to explain what the difference is right now, other than I don't want to say more about the difference till we get into part 2 of the EA study, because you don't really need it to pass this part of the test. And we will explain that to you. But the difference is A C corporation gets taxed at the corporate level, and then the investors get taxed at their personal level. With a S corporation, it all flows through to the investors personally. Okay?
Okay.
Okay. So let's go on to this. We'll take a look at this screen here. If there is a loss on a Schedule K1, okay, so here's a K1. Are you if you're invested in an S corporation, are you probably a passive investor? Is it a passive activity for you?
Yes.
Yes.
Yeah. So remember the passive activity limitations? Those come into play again. So if you have a loss on a Schedule K1, your basis in the entity, your amount at risk, and your participation in the activity all affect the amount of loss that can be included on your return because of the rules that we already talked about. So if you can have a basis, your investment in a let's just pretend it's just a S corporation right now. Maybe your basis is $1,000 in that entity. So there's your basis in it. How much are you at risk? If that's all the info you have, how much are you at risk to lose?
$1,000.
$1,000. How much I want to be careful on this one because this can get confusing. But if you're just purely passive activity to you, in other words, you just invested and that's all you're doing, that affects how much of a loss you can take. Because what is the general rule about a passive activity regarding losses?
You can't take any more of a loss than the amount that you have at risk.
Yeah. Yeah. The general rule says you cannot deduct passive activity losses. That's the general rule. And then what limits are placed on that? The amount that you have at risk. What other limit is on it? Well, you can't, well, let me rephrase that. How much do you really have at risk? You have at risk the amount of basis you have in it. So if I have zero basis, how much do I have at risk?
Zero.
If I have $1,000 basis, how much do I have at risk?
1,000.
That's right. My point is this. They are pointing out that a passive activity is limited to the passive activity rules that we just talked about. What's the general rule of the passive activity losses? What's the general rule for passive activity loss? I want to repeat it. It's worth repeating. What's the general rule for a passive activity loss?
You cannot deduct passive loss.
That's right. You cannot deduct loss from a passive activity. That is the general rule. I want you to memorize that. That's important. Generally, there are exceptions, but that's the general rule. You also cannot, but you're also limited where you can take some losses because of exceptions, such as the $25,000 for a rental loss. It's still limited to the amount that you have at risk and the amount of basis that you have in it. Okay? So that's all. Partnerships and S corporations use two different kinds of schedules K1. A partnership does a schedule K1, and it actually will always say schedule K1, and then in parentheses have a form 1065. S corporations look like this: schedule K1 in parentheses form 1120S. So you're going to learn something from this. Form 1065, what do you think their form is that they have to fill out when they do a tax return? What do you think their form number is?
N65.
That's right. If you're an S corporation and they're doing the tax return, what do you think their form is?
1120S.
If you're a regular corporation like a C corporation, what do you think their form is?
Something different.
Fair enough. It's actually just 1120. It's just 1120.
Okay.
It's okay. I didn't really expect you to know that, but you can almost guess that it's going to be 1120. Most people would say 1120C, but there's no such thing. They do this tax return. If it's a partnership, they actually do a Form 1065, which is nothing more. The actual Form 1065 is a partnership tax return, just like a Form 1040 is a personal tax return. Form 1065 is partnership tax return. A Form 1120S is a S corporation tax return. So when they do this, they figure out, using this as the example, they figure out how much of the income and various business deductions belong to each partner, and then they put that on a Schedule K1 and they send it to the partner and report it to the IRS. And each partner takes their Schedule K1 and put it into their own individual tax returns. That's how this works. That's why it's flow through, because it flows through as if the partnership or S corp didn't exist. Flows directly, the information flows directly into the individual partners or shareholders' personal tax return. That's why it's called a flow through entity. So before we go into a knowledge check, any questions about what a flow through entity is or kind of what we're dealing with? I'm sure there's plenty of questions actually, but the thing is I just want you to hear that what it really is and generally how it's handled.
Yeah. Can you just please give us a copy of the presentation?
Can you say that again? I didn't understand what you're asking for.
A copy of the presentation.
Oh yeah. I'll send you actually a copy of this as soon as we get done today. Okay.
Okay.
Yeah.
Thank you.
But don't get too hung up on this, because I want you to know that's it for the slides on flow through entities. That's all I need you to know for part 1 of the EA. That's all I need you to know about it. So what is a flow through entity? What really is, somebody define what a flow through entity is.
It's a partnership or S corporation, essentially.
Well,
It's
yeah,
an
they
entity.
are flow through entities. You're right, Garrett. But I want you to define through me what the word flow through means. I guess
It's
that's
an
what I mean.
entity where income passes through to the investors.
That's exactly right. It's where the income and where the income and expenses are not taxed at the business level, but flow through to the individual investors and are taxed at the individual investors on their personal tax returns. That's exactly what it is. What are they report? First of all, partnerships and partnership does its tax return on which form?
1065.
An S corporation does its tax return on what form?
1120.
1120S.
And when they're doing their tax returns, because they're pass-through entities, what form do they have to create for their investors?
Schedule K1.
That's right. That's right. And Amanda had that answer too. That's right. A Schedule K1. What information does a Schedule K1 have? Generally, just what the information is on
Income
it.
and expenses split between the partner's share or the shareholders.
That's right. That's exactly right. Perfect.
So I do have one question. I just want to make sure I understand this.
Sure.
Right.
Sure.
Talk about, as you brought this up, passive activity rules. But a partnership, as I understand it, a partnership, you're involved in the business activity. So that's not necessarily a passive activity. So if you have over $100,000 invested in your business as a partner with somebody else, and you have a loss of, just using numbers, 50,000 reported, you're still able to deduct that, yes or no, because it's not necessarily a passive activity. That's the way I'm looking at it. So that's the part that was
Look, your concept, you're on the right concept, but the numbers are going to be wrong. But the reason, and I can tell you, but I don't want to tell you a reason the numbers are wrong. Let me explain why though. I have to teach you the specifics about partnerships and the partnership rules on that, and they're different than S corporations. And that's part 2 of the EA material that we get.
Okay, that's fine.
I don't want to get that deep into it.
Sure.
You're right. A partnership, really, to be a partnership, most of the time you're an active partner. But have you ever heard of a silent partner?
I have, yeah.
So just pretend it's a silent partner we were talking about to keep that straight. because then it would be a passive activity. It is true that in real life, many times partnerships are active partnerships. You and I are in business together. Neither of us are passive, in which case the passive activity rules would not apply. You're 100% right. But I don't want to go there because that brings in all the different rules, not only for that, but also partnerships. Okay.
You've answered my question anyway. So
Cool. Any other questions? Okay. Then let's do a few knowledge checks. Which of the following is not a flow-through entity? A partnership, sole proprietorship, S corporation, or estate? Which one is not a flow-through entity? 3 of them are, 1 of them are not.
Estate.
Okay, nope. Sole proprietorship. Remember, sole proprietorship, you don't deal with a Schedule K1. What do you do for a sole proprietorship?
Schedule C.
Schedule C, because you're actively involved in it. You're the only person running the company. You're the only person running the company. That's a sole proprietorship. A partnership in S corporation, what we've been talking about, but actually an estate is a flow-through entity. So is it, well, actually, so are some trusts. I got to be careful saying a trust. In fact, set that one aside. Just say an estate is. An estate is a flow-through entity. It's going to flow through eventually from the estate to someone else. It might be somebody might be the estate of someone who's passed away, so it might flow through to the people inheriting the estate, for example. Okay. So that's why that's not the answer. It is actually a flow-through entity. Sole proprietorship.
The back of your Schedule E, if you have that,
Yes,
Part 3 lists estates and trusts on there as well. So
yeah. It's a little bit trickier because I get why some people might think of an estate as not being, but the truth of the matter is, keep in mind what a sole proprietorship is. There's no such thing as a passive activity sole proprietorship. You're either running a business or you're not, and that's what a sole proprietorship is. So that doesn't flow through. That is what you're earning. Okay. Blank is used to report a partner's and shareholders' income from the entity. Which answer is correct? Schedule K1. That's right. Okay. So we actually have finished that. I want to send out to you a copy of this. Let me make sure I've saved this here because I made a couple minor changes. So give me just a moment to save this. Make sure it's saved all the way before I send this out. Waiting for it. Sorry, guys. Takes a moment. There we go. All right. So I'm going to share this with you here in just a moment. And this was 17. So this might take a moment to download. It's downloading, but it'll probably take about a minute. So while we're waiting for this, I want to know if anybody would like to make any comments or anything about self-employment and Schedule C, rentals and Schedule E, or flow-through entities and Schedule E. Okay, so, all right. This has almost come through to you. It's almost done downloading. And you should be seeing it come through to you right now.
Yes.
Okay. So I want to give everyone a chance to download that. So can everyone let me know, just type yes when you've got it downloaded so I know you've gotten it downloaded if you wanted it. Might take a moment for you to download that, and that's okay. Okay. Does everyone got it? I think they do if I see right. So, all right, let's talk for a minute, guys. We're not going to do any more today. You guys have spent the last 4 sessions going through some really deep material, and we're climbing out of the deep material now, that the more difficult stuff to understand, and this is really, really good. And you've done a great job, and I just want you to know that, and I really appreciate it, okay? So you've done a great job. Now, I want to give you guys a break today. We're ending actually in about an hour early, and that's good. So this is what I ask of you, though, to help yourselves now. At this point, make sure to get it caught up with chapters 1 through 9, and please make sure to at the end of each chapter to do those quiz questions, and please make sure to also go and get the additional questions that you can get online by signing up with that with Passkey. Okay. Beyond that, we've gone through everything we need to do. I want to tell you what we're looking at starting next session. We're going to be going into chapters 10 and 17, and I want you to jot that down because we're jumping a little bit out of order. 10 and 17. And I'm jumping a little out of order because I can teach these two things together and it'll help make a little bit more sense. Because what we're going to be discussing is we're actually going to be discussing retirement types of income. But remember now, we're going back to where we were when we set things aside. We're starting to get back into what is income and what is not income. Remember that handout, federal income or not. We're getting back into that. We just spent last session and this session talking about self-employment income and rental income and flow-through entity income. Now, we're going to talk about retirement income next session. So, I have nothing more. I do want to open it up for any general comments or questions before we finish for the day.
Can I request one more presentation to be given? The depreciation.
Let me find it.
Because I'm trying to find it in the website. It is not yet downloaded.
Yeah, I think a lot of that part hasn't been downloaded. So give me just a second.
That's true.
I'll give you my personal PowerPoint on that. Give me just a minute. It will get caught up, guys, but sorry about that. But okay, there's the personal PowerPoint on basis and depreciation. I am going to send you, I think, the other one that went with it that was part of the basic tax prep course. It's much more involved, but I do think it will help you. So here it comes. This is going to take about a minute to download, and it's capital gains and losses.
Yeah.
These are the ones that took us so long to get through. In fact, I'm going to send all 3 to you, but it'll take a moment for this to download. What this is this is the capital gains and losses. This is where we went into talking about what is a capital gain, what isn't, what does it take, what does it take to calculate. In fact, I think I added in, I created a new thing, and I'm trying to remember if I did it separately. So let me get these down to you, and there may be one other thing. I see your question, Manda, while that's downloading. Yes, I think so, if I remember right. It may have started the Friday before that. It may have been started the session before that. I don't remember exactly which session right now.
I think it started Friday.
Okay, so in that case, we would have started with the first item that I sent you, and then we would have finished up and then continued on the next session with the one I just sent you. And I'm going to share another one with you. And this would have been the special considerations for depreciation. What they were talking about there, the special considerations for depreciation had to do with Section 179 and special depreciation allowance. So that's what that's talking about, the one that I'm getting ready to send you right now. Okay, so I'm waiting for that.
Is next session the last session for part 1?
No, it's not. No, it's not.
How many more sessions? Next week, 3 sessions?
No, we have about 5, 6 more sessions to go. We have about, actually, it looks like we have 7 more sessions to go.
Yeah, okay.
And I realize I have it broken out, but because the way I'm teaching this, and I'm also trying to feel my way through how much I can help you guys with without rushing it too much, I'm being careful. So that's approximate. I'm already about a session or 2 behind what my original plan was, but that's okay. This has to do with helping you guys learn it, so I'm less concerned about that I keep with a certain timetable. It's more important I help you understand the material so you can pass the test. That's what's critical, okay?
Yes.
All right, so there's one other thing I'm looking for, and so give me a moment. I think I did something else. I'm sending out one that I also did a day or 2 ago. That talks about just sales. So make sure you get that one too, because that'll help you. So the big picture was, we talked about all these little things going back to the beginning of this course. We talked about all these little things that you need to know, like who has to file a return, who does it, what information do you need to collect, who can be on your tax return, who can't. Then we started into what types of income must be included on your federal return and what types do not have to be included on it. Then we had to suspend that for about 4 sessions where we talked about basis and how basis affected and why did you need basis. You needed it to determine depreciation, and you also needed it because it affected the Section 179 considerations and special deduction considerations. All those things needed to be considered. And then why else did we need basis? We needed it to calculate sales, the gain and loss on a sale. That's kind of what we did. Then we said, okay, now you got this foundation. Now we can go and talk about how this works out for self-employment, where you've got basis in a motor scooter because you need it for your business, and you know how to depreciate it. And you know, instead of depreciating it, you might take a Section 179 instead of depreciation, or you might take special allowance instead of depreciation. Or you might take a mixture of that and some depreciation with it. It depends on what you chose to do and what you qualified for. But we also needed to know what we did with income that was from a sale. You sold that scooter later. You had to know how much gain or loss you had, and part of that you needed to deduct out or determine how much your basis was, because that affected how much gain or loss you had. And then we got done with that. Then we talked about rentals and how similar that is to self-employment. And then we got into a little more detail about rentals and some specifics. And then we talked about flow-through entities for a few minutes. That brings us up to date. All right. Enough of me talking. Anything else you want to bring up? Okay, guys. I will see you on the next session, bright and early for next session. Make sure to please try to get caught up with the reading, the quizzes, and again, just to let you know, the next sessions are going to cover chapters 10 and 17, and really we're just talking about retirement and retirement income of different kinds. Okay?
Okay.
All right. Bye, everyone. Have a great day.
Bye.
Bye.
Bye.